Hey everybody, welcome to another Trader User Group Weekly Roundup. This is for the trading week ending January 23rd, 2015. What I've got on my screen here is the E-mini S&P 500 futures. I've got the daily chart up here, and it's going to switch back from white to blue to green. Screen here, that's just the way my system works with WebEx. But anyway, what you can see up here is the daily chart. The green dashed lines are the all-time highs for the E-minis. The red dashed lines cap the high and the low for 2015, and then the blue line is the opening line for the E-mini S&P 500 for this year. And you can see we are slightly below the blue line, which means we are slightly underwater for 2015. Now, let me show you something about this pattern that's got me just a little bit concerned, or actually a lot concerned, quite frankly. And as we look at this, you can see what started out to be a, and if we were to draw a neckline like this, it started out to be a head and shoulders pattern, came back down right there, and then it failed, and then we started back up again on the announcement of the stimulus and so forth with Europe that came out this past Thursday. Now, I suspect and I told our members, we're running into a lot of resistance in this area. This is the opening price, as I said, for 2015, and this is the intraday high for 2015 for the S&P 500 E-mini futures. We've got a lot of activity going on worldwide this weekend. We've got some more issues in the Ukraine with Russia, and it looks like in the Greek elections tomorrow, the Liberal or Socialist Party is going to win, which could also send some more volatility into the markets. And, you know, we saw that as the market started to come into close this Friday. And what I did was I immediately came out and took out a short position in the E-minis. Now, if we look at this again, this is a daily chart. And I had told our members that what we're seeing here is this resistance in this area here. I called it an R1 zone rather than a specific price. I said if we can penetrate that area, I do believe the overall bias right now, January going into February, is still going to be in a down mode, okay? And even though we've got a mixed signal on the daily chart here, I do believe that we've got a lot of risk at play, and the risk of a bigger move is clearly to the downside rather than the upside. I said if we clear the intraday high for 2015, which is 2067.25, we're going to come up and probably very quickly take out the all-time highs for the E-minis, but I don't see that happening. If we do, just like this particular down move here, because I had our members ready for that trade right there, we're going to have another one when we get back up there again, and I think we're going to come back down again. So as we start off 2015, net, there's going to be a lot of chop in the markets. Now, we did play this move up here. I was short VXX, it's a great way to play volatility to the downside. When we had elevated volatility down in this area here, but we formed our intraday low for 2015 at 1970.25. I do believe we're possibly going to be able to take that number out coming up through January into February. Now, I may be wrong. I may see something on this chart next week that would change my opinion, but that's the way my bias is being driven right now. If we look at this chart again, let me get the subcharts on here. Let's see, restore my subcharts. Okay, here we go. You can see we had this set up very nicely. And keep in mind, right now, when volatility goes up, correlation among all the stock sectors in the S&P and most stocks goes up. And basically, in simple English, what that means is when volatility goes up and the markets start coming back down, then when the markets are moving down, over 80%, 70 to 80% of all stocks are moving down, no matter how good those stocks are. And it also just so happens that we're going into the thick of the earnings season this week and next week. The banks kicked it off with lower than expected earnings. So the financial sector's not doing very well. But we've got to stay in tune with the E-mini S&P 500 and the Russell. That will help guide us for all the other trades that we're doing or that you may want to do. Should this give it up and come back down and take out that level right there? Now, I did say the 2026 to the 2024 area right here is a key support zone. If we take that out, our S1 zone, we're going to come down and probably find ourselves stair-stepping back down and challenging the lows for 2015. All right. And I do believe that should we end up in this area up here and challenge this high here, the MACD is probably going to set ourselves up for a very similar pattern that we had right here. Where we're up here and then we come right back down again and we stay in this wider range here, at least through the year. Okay, now if we do get up at this peak here, I could see just market makers doing what they normally do, taking out that number and then rolling over. I do know that there's going to be more sellers of the E-mini as we move up in this zone up here. And then it'll probably revert to buyers down here, which gives us this kind of movement like this, okay? So that is where I'm seeing everything right now on the E-mini, and that probably could be characterized across all the charts right now. You know what forms a trend, right? A lower high, a lower low, a lower low, but we came right back up and we stopped right there. So we didn't make a higher high, all right? And if we come down and stay north of this area here, now we're not in a trend, we're in a consolidation pattern like that. And we're going to be stuck in that pattern until we take out either that intermediate pivot high there or this intermediate pivot low there, okay? Right now, the odds favor a takeout of this intermediate pivot low, coming down and testing another further down support zone right now. So as we went into close on Friday, I put in my chat room, all you members saw me, I was taking out shorts in the S&P 500 futures. And then we had a sell-off into close. And the markets really had a pretty good little sell-off in the close. If we come into the 120-minute chart, as you guys know, it's a great chart to use kind of intra-day basis to get a good idea of where we're going and where things are setting up here. You can see right here, now each bar, let's get rid of that. Each bar is a 2-hour chart. You can see right here, we just had the last, from the afternoon hours, the Friday afternoon hours, we were selling off pretty good, okay? And we were just coming right down. Now, from an Elliott wave count standpoint, it would suggest we're going to get an Elliott wave 4 down here, and then we're going to zoom higher and get an Elliott wave 5 up here, somewhere around our intraday high of 2015. Now, that's what the Elliott wave count is telling us. Now, this count, you know, you got to be careful the way the Elliott wave count runs, because sometimes it'll recalibrate based on the current price action. But this is what it would suggest right now on the 2-hour chart. Now, that would go in keeping, and should we get up in this area here, I would expect a further pullback here, at least to a prior pivot low here on the daily chart, which was this I don't know if you can see it, the 1970-25 number. So, coming into Monday, the price action would suggest more downside action and higher volatility. If we step back out again to the daily, and let's bring up the Russell futures, which is another important chart. You can see on this Russell futures chart on the daily, again, the green line up here, the green dashed line, you can barely see it's all-time high for the Russell futures. The red line at 2011 is the intraday high for 2015, and the blue line is the opening price of the rut, and we're below the opening price of the rut for 2015 as well. And you can see right here on the rut, we are comfortably, at least right now, we are comfortably above the 50 EMA, which is this red line right here. And the rut is performing a little bit better than the S&P 500 for 2015. But we are clearly in this trend to the downside since we kicked off January this year. And like the E-minis, we've got a wide resistance zone up here. And should price get up in this area, it's not going to elevate the MACD very much, and that would give us another bearish divergence trade similar to this one that we got here for this big move down here, okay, from this peak right here to that peak right there. We had that up. So we could be setting this same kind of pattern up. Either way, I want you guys to understand that the markets tend to suggest a little bit more downside action here in the rut, okay? So that is a little bit about where I'm calling this. Now, the other one that just totally blows my mind is the, and it's not only my mind, but it's everybody else's too, is the U.S. bonds. Look at the bonds here, guys. This channel goes all the way back to the beginning of 2014, and we've been inside this channel. We've had a couple of times we've strayed out, but the 200 EMA held us up, this yellow line. But we're towards the top here, and should we get a spike down in equities, then we're going to continue. We're probably going to challenge this high right here and just keep right on moving up. There is absolutely no divergences in this trade right here. None from this peak to this peak, and none as we stair-stepped up like that from these peaks right here. There is absolutely no bearish divergence. There is a lot of money coming into the U.S. bond market. Most of it from overseas, so the Feds can thank Japan and Europe for putting a lot of money in the bond market. Now, I've talked about this, I think, every weekend for at least several months. And that's what's happening right now. At some point, it's going to break. Right now, it's holding up fairly nicely. I would not be surprised to see a final capitulation up here, a big thrust up, and then a roll back down. I know there are a lot of traders that are shorting up here, and they're holding on painfully so. They started their shorts up here. Or back in this area right there, and they never really got out. And then there is some capitulation on this big move here, and then there's more people pitting in shorts up here. So, but again, it seems like most American traders are shorting the bonds, and Europeans and Japanese are going long U.S. bonds, primarily because the bond market and the treasury market, government securities in Japan and in Europe are either zero or pretty close to it, or in some cases, shorter term, they're negative. So it's just amazing what's happening with the bond market. The other thing that's got me concerned with the bond market is this would suggest that there is still a lot of unpent up fear in the markets, and money just does not want to go out in the bonds into the equity market. So we got to be very careful here, folks, very careful. Our time will come for picking a short in bonds. Right now is not the time. Currencies, wow. Did we have fun this past week? Now, we've been short the euro for quite some time. If we look at the euro here, let me just get the chart back up. This is a daily chart of the euro. Look at this. Let's put it on a weekly, just kind of give you guys an idea just what this thing is doing. Look at this. This is a weekly chart of the euro. We've been short the euro for quite some time. In the futures market, it's really good. Now, my initial target for the euro, and I've talked about this, and I've showed this on previous weekly updates, roundups, is down here around the 108 area. And, you know, as soon as we broke, again, folks, this is a weekly chart. As soon as we broke that area, this has given me a time and price of anywhere from February, okay, all the way out to the May time frame this summer of coming down into the 108, you know, to the 107 area, roughly. So February to May. Now, I can expect some counter trend moves, and it'll look something like that, okay? That's kind of how this, because this support line is calculated off of a combination of GAN, which does take into account time, as well as Fibonacci. And GAN also takes into account price. Fibonacci also has, you can use the Fibonacci time swings as well. But that's kind of what this is planning here. We've been short the euro or short FXE, which is a good trade to make on the euro. Now, another counter trend move here, or it moves the opposite. We've also been long the dollar. And if you look at the dollar here, this thing has just gone to the moon. No bearish divergence here, just like there's no bullish divergence on the euro. So now we're sitting here, and again, let me just show you a couple of key magic points here for the chart. I'm gonna zoom in. This is a weekly chart. Notice I've taken the high and the low, going all the way back to 2001 for over the past 15 years. And we're coming up on a key magic point here, a very key Fibonacci extension off the lows right at 9.6. And I said that is a good point here where I think the U.S. dollar is going to, and you can see we just went right up far. And we're just slightly south of it right now. We're probably going to chop, maybe get, have a little bit of a pullback, which would be the counter trend rally in the euro, and then boom, we're gonna come back up and just keep right on going. Okay, so I think the dollar again is going to get stronger and stronger and stronger as we go into the summer. The euro is going to get weaker. Now, the ECB came out with their roughly about 1.1 to 1.2 trillion, capital T, euro buying program through September of 2016 at 68 billion euro a month. At the rate they're going, that'll be worth a few dollars. But that's what they've committed to through 2016. So remember what happened to the dollar. And if I clear this up right here, this is the U.S. dollar chart weekly. You can see when the dollar just started, when they started back here, counterintuitively, when the U.S. government, the Fed, started putting a lot of money and driving interest rates down here, you can see how choppy the dollar got, right? The dollar got very choppy, and all of that money started taking hold, but it did drive the U.S. dollar down here. Again, this was the pending collapse of the 2008 crisis here. But I want you to understand this pattern, because just because interest rates get very low does not mean you can't have counter trend moves in the euro, and we're going to see them. But the dollar is only at a 50% extension off the range that it's been for the 15 past years. So I do believe we got more upside with the U.S. dollar. Now, the other one that I am still short on, which is very interesting to me, is the British pound. The British pound is just getting whacked. It's like a whack-a-mole with the currencies. Here is the daily or the weekly chart of the British pound. Here's that same Fibonacci extension. You can see from the high to the low, and the British pound is just the opposite. It couldn't quite make it back up to the 50%, and it's rolled back down. Look at that tight channel that the British pound is staying in on this weekly chart. So we're going to come down in all likelihood and test this key area here, which would suggest, well, let's get this back off the screen here. But this would also suggest that the pound is going to come lower. That's a key pivot there. Should that break, then we got even lower to go, 1.42 down in this area here. But right now, on a near-term basis, 1.48 seems like a logical initial resting point for the pound. There's no bullish divergence in this thing, so I do see more downside action as we continue this thing out. If I come in on a daily chart, you'll see just how severe the currencies in all markets have been just cratering here. Look at this. I mean, it's just amazing. And I still think, again, we've got 1.48 next stop, and I think over the summer we're going to be down to about 1.42. Now, we could see a parity in the U.S. dollar and the euro, which would not be good for the British pound, because remember, they get a lot of their exports from Europe, the ECB, the 18 countries that make it up. So there's going to be some issues there. And then you throw in all this flux with Russia and the Ukraine. There's a lot of fear out there. You got Greece. Will they or will they not stay in the European Union? They're probably going to stay in, but I guarantee the ECB is going to have to rework those loans for Greece, which means the other countries that have loans with the ECB are going to want to rework their loans. That's going to further weaken the euro. and just, you know, the overall economy there. So there's a reason why U.S. bonds are still at a very, very low interest rate standpoint. Relative to the other countries, it's very high. That's why money is flying in there. The other surprise move was in the Canadian loonie, the dollar, the Canadian dollar. They call it the loonie. If you look at this, again, capitulation. They're getting killed because they do a lot of export with oil, and as oil is getting killed, so is all currencies of countries that rely on oil. This thing can go down even further. I think the Canadian dollar or the loonie is going to come down to 0.76. I mean, it's a daily chart, folks. Just ugly, 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 ugly. The U.S. dollar is really the only currency right now of record that makes sense to anybody. Gold, we've been long gold. I went long gold a couple of weeks ago. We caught this move very nicely. You can see right here, I pointed it out. I think even on this weekly update, it was a reverse head and shoulders. We had a break there. We went long right there. The target for this is up in this area right here. We got right up there, a little bit of a pullback. Now, if there is fear in the marketplace with contagion in Europe and the Russian thing, that'll move gold back up, and it'll challenge this prior major pivot high right there with gold. So we've been playing this to the long side, some using GLD, some using the futures, and then some using GDX with gold miners, because that's also doing very well. But it doesn't really matter. Pick your area, pick your underlying asset. They're all working out well in the gold market. Now, the other one that, and silver. Silver's another one that I recommended along to it longer term. And you can see silver had this break right here. This goes back, this trend line, down sloping trend line. Let's come back out on a weekly. You'll see it. It comes way back here to 2011. You can see this is the first break right here, and we've ridden this trend line all the way down. We had our first break last week. Minor little break, poking its head up a little bit. We got longer-term bullish divergence that would suggest longer-term we're going to be moving back up. But this is a trade where you need to have patience, folks. I've suggested to a lot of members that are more conservative by nature, just picking up SLV, shorting longer-term calls against it, and using the premium and the short calls to buy puts. It's like a collar, very conservative, but you can do double-digit returns on that with silver right now, the way it's set up. I do believe longer-term silver is going to be in the 20s. Energy, oil. I don't think oil is done to the downside. I know a lot of people are trying to catch this sucker on the downside, but I don't think it's done. You can see this little zone here that we broke out of. This is a weekly chart. I think the next stop down could possibly be 40. If we come to the daily chart right here, by the way, we call this down move. I called it down to 50. And you can see this zone. We just broke out of it right here. This is a daily chart. So I do believe the downside action is greater than the ups, or the risk of downside move is greater than the upside move. So that's where I think we are with oil right now. Okay, more downside action. Gasoline, it's trying to find a consolidated bottom here. Gasoline looks a little bit stronger than oil. You can see this little bit of a consolidation pattern right here. If we can break out and start running up, I'm going to go long gasoline or UGA. I know our members, I'm going to show you guys that in our sessions here as we come up, but I think that'll be a good potential trade. Remember, we got a lot of imbalances in the market right now. Bonds are imbalanced. Interest rates are imbalanced. We've got an imbalance in the energy markets. And those and currency market, we got a dramatic imbalance. Imbalances are great for traders. We can ride these things if you know how to pick your trade and run with it. Now, one trade I did go long on but I did a ratio diagonal the way we know how to do it. You can see XLE. It's been moving up. Now, I think we're going to be in a little bit of a choppy mode here with XLE, but we had a great bullish divergence here. And then here's XLE on this trade right here. So I do believe that this thing can run a little bit. So let's see how this thing plays itself out. That's XLE. XLE doesn't follow oil because you can see XLE's been moving up while oil's been moving down. XLE is composed of drillers, producers, refiners. So I think and they pay dividends. So there's going to be a limit to just how far down XLE will go. And it has been decimated over the past 6 months. So we're going to make that play and run with it. All right, everybody, that is a very quick and fast update for this week. I would like to encourage a lot of you members that or you folks out there that are watching this, whether it's on YouTube, LinkedIn, or you get the email or friend has referred you, I highly suggest you come on in and join us. We're doing really well. We had a good 2014. 2015 is off to a great year. We're outperforming the markets. And I think with these imbalances, we're going to have some great trades coming up. Everybody have a great weekend, and let's get ready for the Super Bowl next weekend. Take care, everybody. Bye now.